If your agency is chasing AI, niching, data, and new growth channels in 2026, but your accounting is still stuck in last year's tax return, you have a problem. Because growth does not create opportunity. It creates tax consequences, cash flow pressure, entity questions, hiring decisions, and reinvestment decisions. And if you're not planning for those ahead of time, your growth may cost you more than it should. Hi, I'm Craig Cody. I'm a CPA and certified tax coach, and we work with marketing and PR agency owners to help them keep more of what they make, improve their cash flow, and make better financial decisions as they grow. Recently, I listened to Drew McLellan as he spoke with John Hall on the Build a Better Agency podcast. They spoke about the major growth trends shaping agencies in 2026. AI visibility, niching, boutique trust, community, data, and the return of more human analog experience. All very important. But today, I want to talk about the money side of that, because every agency growth trend has a tax and an accounting consequence. And the agency owners who understand that early will make better decisions than the ones who wait until tax time. Point 1, AI visibility may grow revenue, but it can also hide profit problems. One of the big points from Drew and John's conversation was AI visibility, showing up in ChatGPT, Gemini, Perplexity, and other AI-driven search tools. And that can create better leads, more qualified prospects, higher close rates, and for some agencies, it may become a serious growth channel. But here's where agency owners need to be careful. More leads do not automatically mean more profit. Let's say your agency starts getting better inbound leads because your niche content is finally being found by AI tools. And that sounds great, but what happens next? Do you hire too quickly? Do you add delivery capacity before the revenue is stable? Do you price the work based on old assumptions? Do you know whether the new work is improving agency gross income or just increasing gross billing? That distinction matters. Agency gross income is the money you actually have available after pass-through costs, media, and freelancers, and other direct costs. If you only look at that top-line revenue, the vanity metric, you may think the agency is growing. But if agency gross income is not growing the right way, your cash flow may still feel tight. The accounting move here is simple. Track AGI by client, track gross margin by service line, track utilization, and make sure your monthly financials show whether AI-driven growth is actually creating profit, not just activity, because a busier agency is not always a healthier agency. Point 2, niching. Niching creates premium opportunity, but your numbers need to prove it. The more specific your agency becomes, the easier it is to stand out. And it's especially true in an AI search environment. A generalist agency saying, "We do marketing for everyone," is going to have a harder time being remembered, referred, and surfaced, versus a PR agency for healthcare technology companies, or a paid media agency for home service brands, or a content agency for private-backed B2B companies. That is much clearer. But here's the money side. Niching should improve your economics. If it doesn't, something is wrong. A niche should help you create repeatable process. It should reduce wasted time. It should improve pricing power. It should make delivery more efficient. It should help your team get smarter faster because they are solving similar problems for similar clients. But you will not know if that is happening unless your accounting is built to measure it. If your books are only set up for tax preparation, you're missing the point. You need to know which niche clients are most profitable, which services are dragging down your margins, which retainers are underpriced, which products look good on the proposal but fall apart in delivery. This is where monthly accounting becomes a growth tool, not a compliance exercise. Your CPA should not just tell you what you made last year. They should help you understand which parts of the agency are funding the next stage of growth and which parts are quietly draining your cash. Point number 3, data and AI services may create new tax planning opportunities. Drew and John also talked about the growing value of data. Agencies can now use data research and AI tools in ways that were either too expensive or too difficult a few years ago. And that creates new offers, new service lines, new client value. Maybe your agency is building proprietary dashboards. Maybe you're creating research reports. Maybe you're developing internal tools to improve delivery. Or maybe you are packaging data insights as part of your client strategy. That's the real opportunity. But here's the question most agency owners forget to ask. How are we treating this financially and tax-wise? Are these costs being tracked separately? Are you measuring the investment? Are you building something that may become intellectual property? Are there technology or software development activities that need to be reviewed for potential credits? I'm not trying to say that every agency automatically qualifies for credit, and that would be irresponsible, but I am saying this: if your agency is investing in technology, data systems, software workflows, or new tools, those activities should not be buried in random expense categories. They should be reviewed, they should be documented, and they should be discussed before the year is over, because tax planning works when it's proactive. After December 31st, many options are going to disappear, and that is why the agencies making serious investments in AI and data need a CPA who understands what they are building, not just someone who categorizes expenses after the fact. Let me ask you this: where do you think your biggest 2026 growth investment will be? AI, a new niche, hiring new employees, data, or some other service line? Drop it in the comments, because that answer tells you where your tax and cash flow planning needs to start. Point 4, growth requires estimated tax and cash flow discipline. This is the part nobody likes to talk about. Growth can create a tax surprise. If your agency has a better year in 2026, your estimated taxes need to keep up. If you wait until the return is prepared, you're looking at a big surprise possibly, and possibly a painful balance due. That cash may already be committed to payroll, software, contractors, or in reinvestment. And this is why cash flow forecasting matters, not once a year, not when things get tight, every month. If your agency is scaling, you should know what cash is coming in, what payroll is going out, what tax liability is building, what receivables are aging, what large expenses are coming, what profit is real versus just sitting in the accounts receivable. And this becomes even more important when an agency is growing through retainers, larger projects, or new service lines. The timing of income and collections matters. A profitable P&L does not always mean strong cash flow. And an agency owner who does not understand that can make expensive decisions that they're making confidently. The practical move is to build tax projections into your monthly financial rhythm, not as a year-end scramble, as part of running the business. So in summary, here are some takeaways of Drew and John's conversation. AI visibility, niching, community, data, and new ways to grow. Those trends matter, but growth without financial structure is risky. AI-driven leads need margin tracking. Niching needs client and service line profitability. Data and technology investments need documentation. And every growth plan needs estimated tax planning and cash flow forecasting. The agencies that win in 2026 will not just be the ones that grow, they will be the ones that grow with clean numbers, clear tax strategy, and enough cash visibility to make smart decisions before problems show up. If you own a marketing or PR agency doing between $1 million and $10 million in agency gross income, and you are looking at 2026 growth, but you are not sure your accounting and tax planning are keeping up, let's talk. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got 2 things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.